Well, hello and welcome to our virtual online event. We're going to get started in about 1 minute as we let a few last minute stragglers get logged in. So we'll get going here in about 1 minute. All right, we'll give it about another 30 seconds and then we'll get started. All right, well, hello, ladies and gentlemen. My name is Chris King, and I'll be your host and speaker for today's webinar entitled, What You Don't Know About IRA Distributions Can Hurt You. Well, wouldn't it be nice to know your retirement is all taken care of? And wouldn't it be nice to know you've got a safe, efficient, worry-free plan with no more worries about retirement? Well, for 25 years, my practice has focused on retirement and income planning. I do three things very well. Number one, protecting the wealth that you've worked for 30 or 40 years to build. Number two, to help you earn a reasonable rate of return on what you've accumulated. And number three, when the time comes, to create an income stream you can't outlive. I've found that the biggest fear that people have is outliving their money. And I feel I have the solution. I've helped my clients safeguard their assets through what is now 3 major market downturns. And my clients didn't lose a single penny during those years. I've also found that it's not always about accumulating the most money, but rather using your money in the most efficient way. So I'm here to guide you, to help you manage your provision so that you can truly enjoy your retirement years worry-free. My approach is simple. I ask a lot of questions, and I want to know what it is that you want. What are your dreams? What does your ideal retirement look like? What's on your bucket list of things you'd like to do? Do you want to travel? Take the whole family on a trip? Spend more time with the grandkids? You see, I believe your most precious resource in retirement is not your money. It's time with the ones you love. And therefore, I help you create a safe, efficient, worry-free plan to make your provision, what money you have, work for you. Wouldn't it be nice to know it's all taken care of and no more worries? I sincerely hope that we earn the privilege to welcome you into our family of clientele and help you achieve your dreams. I am a native North Texan. I grew up in Garland. My wife of 26 years and I have lived in Rockwall since 1998. We have 3 children, 2 daughters and a son. We also have 3 of the cutest grandkids you've ever seen. We attend Lake Point Church in Rockwall, where I've played the bass guitar in the band for going on 30 years now. My wife and I, we love to travel. We try to go to the Smoky Mountains every chance we get. We just love the mountains and the trees. All right, well, as we get started here, first a short disclaimer that this presentation should not be construed as specific investment, tax, or insurance advice for your particular case. I'm not a CPA or a tax attorney. Now, we do like to work with your CPA and tax attorney if you have one. It's always a good idea, especially for your CPA, to know what's going on. And I want to make a promise to you today. I promise that you're going to get some knowledge and actionable information that you can utilize. I also promise that I'm not going to leave you without getting your questions answered. So I'm going to offer you a free, no obligation session. And this is to discuss your particular situation and get your questions answered and your concerns addressed. Now, this can be a 15-minute phone call. It can be a 30-minute Zoom call, or I can come visit you at your house. I have an office in Plano, but we haven't been utilizing it due to the COVID issue. So, but either way, however you would like to do that, we will make that available to you. All right, so let's jump right in here. Okay, so would you like to pay less taxes on IRA money? Would you like to be able to retire without relying on Social Security? Would you like to get the government out of your pocket? Boy, I would. That's a good one. Would you like to have plenty of income and never again worry about taxes? Well, the first thing that's important for you to recognize are the risks that you face moving forward in retirement. Now, regardless of whether you are still working and approaching retirement or already retired, and I know there are some who retired and then started working again. In any case, there's certain risks you face going forward, and unfortunately, those risks they just get worse the longer you live. Well, here's a look at what those risks are. The first one is market risk, and this is a big one. I'm sure that the vast majority of you have money invested in the market, whether it's self-managed or through a broker or advisor, or even a professional money manager. Obviously, we know that if the market drops, you have the risk of losing a big chunk of your retirement assets. You may remember the market lost 44% in 2000, 2001, and 2002. Then it lost 37% in 2008. However, from the start of the crash in 07 until the bottom in 09, the market lost 55%. Imagine if we had another 55% loss, let's say in the next 3 months. Are you in a position to protect yourself if that would happen? And how many of you are concerned about market risk? Do you have time to recover at your age? You know, the most recent crash you all felt, and hopefully now you're recovering from, it started on February the 12th of this year. And at the bottom on March 20th, it was down another 37%. Amazingly, the market over the last 21 and a quarter years has only averaged 2.56% per year. As of June 19th, 2020, only 3.95%. So why then would you want all? And don't get me wrong, I still believe you should have some in the market, but why would you want all of your money in this market with all of the volatility and the risk? So now we're going to talk about some of the fees that are an additional expense on your portfolio. Let's talk about the undisclosed fees in mutual funds. According to the Wall Street Journal, these market losses are compounded by being in mutual funds. Let's look at someone who retires with $500,000 in mutual funds. Again, according to the Wall Street Journal, the average expense ratio nationwide is just under 1%. Let's assume your mutual fund manager has $800 million in funds to manage. Do you believe that during the course of the year, they might sell some stocks and buy some others? Of course. Now, they can't do that for free. They have to pay transaction expenses, and according to the Wall Street Journal, the average loss per year to these fees in mutual funds is 1.44%. And then finally, each fund manager always holds some of the fund assets in a cash or money market position. This is money you don't make anything on. And again, the Wall Street Journal says you lose 0.83% per year of potential growth due to this. Now, let's look at what this costs you per year. If you pay your 401k fees or a broker fee of 1%, that's another $5,000 for a total of 4.17% in this example. If you lose that much per year over a 25-year retirement, you lost $521,250. Wouldn't it be nice if you could keep that money? Now let's look at the flip side of the coin. If you don't like the volatility of the stock market, well, what's your other choice? Bonds? But look at where interest rates are. These are some of the lowest interest rates we've seen in modern history. It's great for borrowers. You've probably noticed how cheaply you can get a home loan, but it's really hard on savers. That's because low interest rates are causing lower risk investments to return very little. If you believe, like I do, that someday soon rates may go up, then bonds will lose value. And that's because they have an inverse relationship to interest rates. Here's the takeaway from this short discussion on the market. If you're in a 401k, there's really nowhere to hide. You either have to accept a lot of risk or accept very low growth in your account. And if rates suddenly rise, you lose even more money by being in bonds, especially bond mutual funds. So I want you to look at the red dips on this chart. This shows you what happened to the value of bonds during periods of rising interest rates. Let's look particularly at 1980 and 82. Remember in the 80s when CD rates were through the roof? People were getting double-digit returns on their certificates of deposit. How many of you got a free toaster for opening an account? That's what they were doing back then. What percentage did bonds lose during the Jimmy Carter inflation era? Well, it was about 68%. So how many of you believe rates will continue to go down further and further? And then how many believe rates will someday more likely go up? Now, for everyone who just answered yes, they'll go up, do you have bonds or bond mutual funds? If so, you have very low returns and the potential for significant losses should rates increase down the road. We help our clients find bond replacements that will do well when rates go up and potentially offer better yield opportunities. Now let's talk about the second retirement risk, which is tax risk. Folks, our country is approximately 26 trillion in debt. That's trillion with a T, $26 trillion. You know, Will Rogers said Alexander Hamilton started the US Treasury with nothing. And that's the closest our country has ever been to being even. That's about right. We're spending 5 trillion and bringing in 2. I'm thinking that taxes are likely to be higher than they are today. And if we want to pay off that debt, well, taxes are probably going to have to go up. So if you want to save hundreds of thousands of dollars in taxes, you've got 5 years to do it. First, let's take a look at the history of taxes in America. I found an interesting quote from Benjamin Franklin in Poor Richard's Almanac. He said it would be a hard government that should tax its people 1/10 of their income. Keep that in mind as we go through these rates. During FDR's presidency, the top tax rate was 94%. 94%. FDR actually proposed a 100% top tax bracket in 1942. And during JFK's presidency, it was 91%. Now, it could be said that those highs were due to World War II, the Korean War, and the Vietnam War. How many of you have heard Washington say that this virus we're going through is indeed a war? Today, our top tax rate is only 37%, and we say only. Old Ben Franklin wouldn't believe all this, would he? Now, of course, not everyone pays that top tax rate. In fact, it's only a very small percentage of taxpayers that do. That said, with our national debt at all-time highs, the recent coronavirus pandemic, a budget that hasn't been balanced in years, and fiscal troubles for many of our entitlement programs like Social Security and Medicare, it's possible that rates could go up across the board. And that makes coming up with the right plan even more important. So I'd like to introduce you to Tom. He did like most folks do and maxed out his 401k while he was working. He retired 4 years ago with 90% of his investments in his 401k, and something pretty interesting happened. Tom wanted to be debt-free, so he decided to pay off the final expense of his mortgage, and he had about $50,000 remaining on his house. So he wanted to withdraw the $50,000 from his 401k to pay it off. Unfortunately, when Tom called to get his money, he was told that he'd only get $35,000. This is because he has a partnership in his retirement money with the IRS. So Tom asked, how much would he need to withdraw to net the $50,000? Well, Tom would need to take out $71,428 to net the $50,000 that he needs. So here's a question. How many of you would be quite upset to learn that you'd need to take out and pay tax on $71,428 to pay off your $50,000 mortgage? You see, the problem is that Tom had the majority of his savings in his 401k. Most people, when they think about it, have the same problem, in that the largest portion of their savings and investments are in partnership with the IRS. One of the things that we work on for our clients is helping them transition from what we call tax-infested money to tax-free money. The longer you wait, the more you'll end up giving to the IRS. This sample statement illustrates the mistakes that many folks make in their retirement planning. They look at their statement and they add up all their money and they say, I can live on 4 to 5% of that. But they forget about their partnership with the IRS. And in this case, they don't have $377,000. They only get $282,000, and the IRS gets $94,000. So if you lose money in the market, it will come back over time. When you lose money to the IRS, it's gone forever. But Chris, my CPA says my taxes will be lower in retirement. Will they? Congress has recently mentioned a number of times that they want to go back to the 1980 tax tables. Let's see what that would mean for a couple earning $153,000 today. Today, that couple is in the 22% tax bracket. adjusted by 2.5% back to 1980, the equivalent income at that time was $60,000. Check out the tax bracket for that income in 1980, 54%. That would be a 32% savings in tax rates today. Folks, with over 26 trillion in debt, and this is a rhetorical question, how many of you believe taxes will go up in the future? So, should you pay the tax today at 22% or deduct it and pay the tax in the future at who knows what rate? Another way to ask that would be, do you want to pay tax on the seed or do you want to pay tax on the harvest? Now, you might think that your income will be much lower when you retire, but by how much? If you're living on $150,000 today, are you willing to live on $75,000 in retirement? Most likely not. Maybe you'd be willing to drop to 110, but guess what? You'd still be in the same tax bracket. And if taxes go up to 1980 rates, it could be 54%. Next, let's talk about inflation and healthcare. And we're going to lump these two together into one solution. As you're aware, the cost of goods rise every year. You got to be able to at least withdraw what the inflation rate is to keep up with it. So the question is, are your retirement accounts prepared for that reality? And then there's healthcare. Anyone here know someone in a nursing home? Most of us want to avoid that outcome if possible. So ask yourself, does your big picture retirement plan take those costs into consideration? Sam Ewing, he was a baseball player. He said that inflation is when you pay $15 for the $10 haircut you used to get for $5 back when you had hair. That's pretty good. So how long will your retirement nest egg last? In 2018, $2,529 was the equivalent of $1,722 18 years ago. When thinking about your income needs in retirement, be sure not to just add up your assets and say, well, I can expect to take 4% of that and I'll be fine. In the last 28 years, you'd have to almost double your income just to have the same buying power throughout your retirement. Now, what if there was a way to provide tax-free income in the future, protect your family's financial legacy, and cover a potential long-term care stay all at the same time? Now, I'm going to do a brief overview of this because I don't have time to share all the details of how to do this right now. However, if it's something you are interested in hearing more about, mark it down and let's talk about it in our consultation. Okay, so I want to talk about Title 26 of the U.S. Tax Code for a moment. First, let me make clear that I'm not a CPA and I'm not offering you tax advice. Please be sure to see a qualified tax and legal professional for questions about your individual situation. Now, believe it or not, this piece of law had a pretty big implications for how you can save. Okay, and this is Section 401k, sound familiar, of Title 26 of the U.S. Tax Code. This is the section where the 401k retirement accounts got their name. This section allows you to put money into a 401k today, let it grow, and leave the taxable amounts in there to keep growing. And then you pay taxes on it later when you withdraw money. How many of you knew 401ks were named for a section in the tax code? Well, they are. And it's just one way the IRS says you can save within a set tax structure. I'm talking about Section 7702 of Title 26 of the U.S. Tax Code. It's actually an older section than the 401k. But there's some things you can do under Section 7702 that you can't do under Section 401k. And that's why Section 7702 is so powerful. It's actually using a special type of life insurance that minimizes the death benefit while maximizing the cash value within it. And here's some of the advantages of a 7702 life retirement plan. There's no limit on amounts invested. There's no 59.5 rule or penalties with loans. There's no age 72 rule for taking out money. You can take it out whenever you want. And it's tax-free income. In most of these plans, make your death benefit available for long-term care coverage. So as I mentioned, if this is something that interests you, be sure to make a note of that and let's talk about it. Finally, let's talk about longevity. Now, what's interesting about this risk is that if I were to take a poll or survey asking what was the most dangerous risk, I'd guess the vast majority would either say market risk or inflation. The reality is, however, that longevity is the biggest risk everyone in this webinar faces. And the reason why? is that it amplifies all of the other risks. Let's just step back and think about it. The longer you live, the longer you have to not just deal with these risks, but who knows what else can pop up in our country in the next 10, 20, or even 30 years. How long must your money last in retirement? Well, if you're a 65-year-old man today, you have a 50% chance of living to at least 85 and a 30% chance of living until you're 90. If you're a 65-year-old woman, you have a 50% chance of living to 87 and a 41% chance of living to age 90. If you're a married couple and you're both 65, there's a 50% chance that at least one of you will live to be 91 and a 31% chance that one of you will live to be 95. So like I said, if you're going to be alive for another 10, 20, or 30 years, you have to make sure that your sources of retirement income will be there to accommodate those years. Now, when it comes to your IRAs and other retirement accounts, you've probably got a lot of questions, and these are just a few of them. The goal of today's presentation is to answer all of these questions. So let's first begin with just a general overview of IRAs. Now, in 2020, the maximum you can contribute to a traditional IRA is $6,000. If you're 50 or older, then you're allowed to make an additional $1,000 catch-up contribution, making the maximum you can contribute to your IRA for 2020 $7,000. Now, you can't always make a traditional IRA contribution, though. For instance, to contribute, you got to have what the tax code refers to as compensation. For most people, compensation is earned income, but it also includes a number of other types of income, such as taxable alimony. It does not, however, include things like interest, dividends, capital gains, Social Security benefits, or unemployment compensation. So most of the time, it's neither you nor your spouse. If neither you nor your spouse work, you won't be able to make a traditional IRA contribution. So when do you have to take your required minimum distributions? It's possible to take your first RMD by December 31st in the year you turn age 72. Or you have a one-time chance at delaying that first distribution a few more months. If you delay taking that first required distribution, you must take your first withdrawal by April 1st of the next year after you turn 72. After the first one, the RMDs must be made by December 31st going forward. By dragging things out until April 1st, you're really bunching up two distributions in one tax year, and that can potentially push you into a higher tax bracket and drive up your tax bill. So in general, most retired people who are no longer working would want to take their first distribution by December 31st and not delay until April 1st. The only exception to taking an RMD is if you're still working somewhere whose retirement plan you're actively taking part in, then you don't need to take an RMD for that plan. You would still need to take an RMD from, say, your personal IRA, however. And then finally, if a client doesn't take an RMD by the corresponding deadline, they may owe a penalty of 50% of the minimum RMD, plus still have to take the RMD and pay taxes on it. So that means if they were supposed to withdraw $10,000 from their retirement accounts in a given year, but didn't, they could get hit with a $5,000 penalty. That's a stiff penalty. Now, for this year, due to the COVID-19, the CARE Act allows you to opt out or continue your distribution either way. Of course, most people don't think about things in terms of factors or life expectancy. So here's a chart I think you'll find helpful. It shows the approximate percentage you need to take out of your IRA from 72 to 95. And this is in order to steer clear of that 50% penalty. If you look, you'll see that each year, the percentage you need to take out increases. That doesn't necessarily mean you need to take out more money each year than the last, though, as that also depends on how much your IRA gains or loses from year to year. So folks, this is a forced distribution. This is the government's income plan for you. They want their tax money. An IRS auditor once said the trick is to stop thinking of it as your money. All right. For the safe people in the group, let's say you're 73 and you have to pull out that 3.78% and you're only earning 1.5 in your CD. That's not going to work out too good. For those of you that are in the market, let's say you're 73 and you got to pull out that 3.78%, and we just went through March and the market dropped 37%. Now you're having to take a distribution on less money. Well, how will you ever catch up? Now, this webinar is entitled What You Don't Know About Your IRA Distributions Can Hurt You. This is a big one. The account value your RMD is based on is from December 31st, the prior year. So let me give you an example of what can happen. If your value was $100,000 back on December 31st of 2019, then the market drops 37% in March and you need to take out your RMD. Well, you're taking an RMD off of 100,000 when your account value may only be 63,000, which would then take your account after the RMD down to 59,220. So the question is, do you have your IRA in a suitable investment for this forced distribution? Is it predictable? Is it safeguarded from market loss? Well, what if there was such a place? Well, there is. And so mark that down and let's talk about it in our consultation. So how much tax liability could your RMD create? I mentioned earlier that you'd want to avoid having to pay two RMDs in the same tax bill. And this is why. These are tax rates in 2020. Now, is it possible that getting a few $1,000s would bump up your income tax bracket? Absolutely. Especially if you're retired and have gone into a lower tax bracket, having not begun to take withdrawals from those qualified accounts. If you look at the 12% tax bracket, married filing jointly, any income over $80,250 throws you into the 22% tax bracket. And that's on the amount over $80,250. So you might be sitting on the threshold of the 22% tax bracket, and then your RMD actually puts you over it. And don't forget that RMDs can potentially affect how your Social Security is taxed as well. If you're single and your provisional income is over $25,000, or you're married filing jointly with provisional income over $32,000, you're going to be taxed on up to 50% of what you get in Social Security benefits. But if you're single with over $34,000 and married filing jointly over $44,000, they're going to tax you on up to 85% of your Social Security benefit. Is it possible that your RMD would bump you up so that you're paying the highest tax on Social Security? Absolutely. These are things that I look at while I'm putting together your overall plan. It's creating a tax efficient plan for you. Now, I have clients that say they don't need the RMD money. In that case, you have four options. Number one, spend it any way you wish. Go on a vacation, a family trip, buy something you've always wanted. Number two, you can reinvest it. Number three, gift it to a charity. Or number four, you can use the RMD to buy life insurance. Now, a lot of people do this as a way to spend their money in retirement, while at the same time not having to worry about whether or not they'll leave any money to their children. Your money is your money, and we're big believers in you spending it. You've worked hard for it. You hit the alarm clock every day for 30 or 40 years. Go out and enjoy it. Leave the kids tax-free life insurance instead, and just use that RMD as the yearly premium. Whatever amount of death benefit you get is what you get. No big deal. Now, let's talk about some possible strategies you may want to utilize moving forward with your IRAs and your retirement planning. The first one is a Roth IRA conversion. And it's a special transaction where you move money from your pre-tax retirement account, like an IRA, a 401k, or 403b, to a Roth IRA. Now, when you make a Roth conversion, the amount of money you convert is added to your tax return for that year, and it's taxable at whatever income tax bracket you happen to be in. For example, let's say Jill has $100,000 in a traditional IRA and would like to convert it to a Roth IRA. Well, we'll talk more about why she might want to do that in a moment, but if Jill moves forward with her $100,000 Roth IRA conversion, she'll have to add that $100,000 of income to her tax return for the year, which will be taxable at whatever rate Jill happens to be at. And now, because this is a big, big decision and it can have a significant impact on your taxes, it's always best to figure this option out with your tax and financial advisors before you do it. And here's a good thing. There are no restrictions on who can make Roth IRA conversions. You can't be too old. You can't be too young. You can be working or you can be retired. There's no minimum amount of income you need or a maximum amount of income you have to have. I think you see what I mean. If you want to convert your IRA to a Roth IRA, there's nothing in the tax rules that will stop you from doing so. Now, this is a sample Roth conversion plan done for one of our clients in 2018. Names have been changed to protect the innocent, but it is an actual client's plan. Making sure not to put this client into a higher tax bracket, and with the approval of his tax advisor, we're converting $38,000 per year from a 401k IRA money into a Roth IRA for 5 years, which that is the amount of time left in the current low tax brackets. The tax savings using the same current brackets would be over $162,000. Now, this is not even counting the potential savings if taxes go higher in year 7 and on. Do you have a plan like this? If not, how much money will you be losing to the IRS? It's really worth looking at. If this interests you, mark that down and let's talk about it. Another way your IRA planning needs to be coordinated with your overall retirement plan is your Social Security claiming strategy. The decision of when to file for Social Security is one that far too many retirees make without thoroughly evaluating their options first. This is a major mistake, and it's one that in some cases can cost you more than $100,000 of income over the course of your retirement. $100,000. Now, the decision of when to claim Social Security is a very personal decision, and one that varies significantly from person to person and couple to couple. That said, many retirement experts today believe that too many people claim Social Security too soon. Remember, Social Security benefits are guaranteed to last your entire lifetime, and no matter how long you live, and benefits are generally increased from 1 year to the next through cost of living adjustments. So additionally, delaying receiving Social Security benefits past what's called your full retirement age, 66 or 67 for most of you, can allow you to earn an additional 8% increase in payments each year until you turn 70 through what are known as deferred credits. So for these reasons and more, it may be beneficial to claim Social Security benefits later than you initially planned for. That's something that we definitely look at. But you have to eat in the meantime, right? That might require you to pull money from your IRA in the meantime to help cover your current living expenses. Retirees sometimes opt not to do this because they say, well, what if I die early? I'll have to spend my IRA money, which takes away from my heirs, and I'll have gotten little to nothing for it. And that's certainly something to consider. But here are 2 reasons you may want to give that approach a second thought. First, a 2012 report from the Center for Retirement Research at Boston College concluded that Social Security is basically the cheapest annuity available. After all, you don't buy Social Security, right? In a way, though, you kind of do. If you use IRA money to hold off on claiming Social Security for, say, a year, that's kind of the price you paid to get the higher benefit. If you compare that price and increased benefit to what you can get from commercial annuity providers, it's almost always cheaper. Another reason it can make sense to draw from your IRA in order to help delay claiming Social Security benefits is that Social Security benefits are generally more tax efficient than IRA withdrawals. Remember, when you take an IRA withdrawal, the entire amount is generally added to your income and taxed at whatever rate you happen to be at. Low rates today, okay? On the other hand, Social Security benefits may be anywhere from 15% tax-free all the way up to 100% tax-free. So the key point for you here is that trading $1 of IRA income on your tax return for $1 of Social Security benefits will almost always leave you with a lower tax bill and more money to spend. So we've covered lots of information today. These are some of the high points, and 1 or more of these things may affect you. When I meet with people, I make sure they understand everything we've talked about. It's essential for everyone to know these things as they navigate their retirement years. Making errors with your qualified accounts can cost you thousands of dollars throughout the course of your retirement, and even after you're gone. So what we suggest and make available for every one of our attendees is a consultation to review your specific situation. Now, we're about to land the plane, but I want you to pay careful attention to what I'm about to tell you. If you would like to have peace of mind about where you are right now in your financial situation, I have something for you. I do something special for people who attend my webinars. I'll put together a report that I'll customize for you when you book an appointment with me, either by Zoom or in person. I use a proprietary tool that will provide you with a retirement income analysis. Do you know if your money will provide you with enough income to last as long as you do? Do you have an idea of how much you'd like to make in retirement, and can your nest egg sustain that amount? Now, whether you simply chat with me for 15 minutes or spend an hour with me, you're going to learn what income you can count on in retirement, spendable income. This will give you tremendous clarity of where you are. Are you okay? Are you not okay? Will your money last as long as you do? That's what I'll show you. Also, how you can minimize taxes to make your money last longer. There are some advantages we have right now in the tax code that you may need to consider for your portfolio. You're also going to learn what rate of return you'll need to average to make your investments last for the rest of your life. Now, folks, most people have never seen anything like this. Nobody's ever taken the time to show them what rate of return they need to make so that they don't run out of money. That's what we do. So book a 15-minute call, a Zoom call, whatever is best for you, and I'll show you. It's worth at least 15 minutes to discuss this. And last, we have a report card on your money to tell you each year if you're behind, ahead, or if you're right on track for your financial goals. So there are ongoing annual reviews because things change and we need to stay on top of it. So after all of this, you're going to have tremendous clarity about your money, your retirement, and your future. That is peace of mind. So we make it very easy to set up an appointment. You can simply click over on the side and you can schedule with me that way, or you can go to my Calendly link, or you can call me at 972-896-8749, or simply email me, chris@ckingassociates.org. I do have an office in Plano, but check with me first on meeting there. If you'd prefer meeting in person, we want to be safe and comfortable about it. We want you to be safe and comfortable about it. So let's talk about that first. Listen, I really appreciate your time today, and I hope that we get to talk soon. All right, y'all have a great day. Thank you.